If I'm talking to somebody and I said, if I own a bank and you own a bank, where are you going to deposit your money? Are you going to deposit in my bank or are you going to deposit in your bank? Well, that's an easy answer. Well, if it's my bank, it's my business, then I'm going to put my money in my bank or my business. And so that's an easy way to think about it conceptually. And then the process of actually doing it is just understanding what type of strategy is going to get me the things that I want, get me the things that I say that I want. And that's where we get to come alongside somebody and help them understand what it means to capture their insurability and really maximize the efficiency of their dollars through capturing benefits and guarantees.
Nelson's number one principle was think long range. And on page 85, he makes this statement about this would take the average person 15 to 20 years. So that's the first piece. And we were talking before we hit record about how wild it is that 20 years goes by like that. So we have to embrace what it really means to think long range, and that's going to be uncomfortable because we live in such a consumer-based, give me, let me have it as fast as possible world that we're all guilty of falling to. So Brock, what does it mean if we were starting today when we started our first policies and we're looking 20 years into the future? What does it mean as far as income expanding and our incomes getting into?
Welcome to the Cashflow Legendz podcast with your hosts Nate, Brandon, and Brock. Remember, our insights are not direct financial advice, so consult with your financial team before making any decisions based on the topics discussed in this show.
Welcome back to Cashflow Legendz. Brock and Nate and I are here and excited to discuss a topic that often comes up when we're getting to visit with people and they've read Becoming Your Own Banker. As we were visiting before we hit record, guys, we were reminded that one of the best ways to overcome worry, fear, angst, anything that's bothering us is to pick one thing we're grateful for. So anybody out there listening that's like having a rough morning or it's been a rough evening or whatever time you listen to this, there are always things that we can be grateful for, even if it's just the ability to take a breath and exhale and do it again. So we hope that you are reminded of that daily. So Brock, we're going to talk about it's really 2 pages in Becoming Your Own Banker, page 48 and 49, and it's called Expanding the System to Accommodate Income. 8 years into practicing becoming your own banker and IBC and the lifestyle behind it and the mindset, this conversation and question comes up a lot. So we know you deal with a lot of entrepreneurs that are younger that, generate a lot of income. Nate and I probably hit more of the household incomes that are, W-2, trying to start a business, those kind of things. So we have different angles that we hear this from, but it really makes people's brains hurt when they read it the first time. I know it did mine. So at a high level, Brock, when someone says, what does it really mean for this to occur, expanding your system and income equaling premiums, where do you start with that? And let's start with somebody who's just beginning, not somebody who's been paying premiums for a long time.
Yeah, absolutely. I think, the question really stems from, I hear people have multiple policies. Why would I have multiple policies? That doesn't make any sense to me. Well, when you think about the process that we're talking about, which is, how are you transferring your savings from residing in your bank account to your whole life policy? Now, let's just say that your free cash flow was $10,000 a month or a year, whatever it may be, right? Let's say,
hey, Brock, let's touch on free cash flow real quick for somebody that just hops on and is like, what the heck does that mean? Give a very simple example of what that means.
Free cash flow or net cash flow is the difference between your income and your expenses, right? That's the money that's left over. And so let's say that you have $10,000 a year of free cash flow right now, right? To start out, we might say, hey, you know what? Why don't you take 5,000 of that and run it through a policy? Easy math. We might not actually say that, but let's say it's $5,000. Well, you've started your first policy with $5,000, but then let's say 2 years later, now your free cash flow is $20,000. Well, you're putting more money in the bank, and if you understand the process and it's likely you are benefiting from it, you might increase or add an additional policy to where you go from paying 5,000 of your free cash flow to 10 or 15,000 into a new policy. And so that is how you would expand your, as the book would refer, your banking system, is as your free cash flow increases, you start transferring that new increase through new policies.
So, Nate, I'm going to ask a similar question because it's right at the very beginning of page 48. Doesn't our income, so anybody listening, watching, whether you understand this concept completely and live it or just heard it for the first time, doesn't all of our income currently get deposited into someone else's bank? Nate?
Yes.
Is that the case? Okay.
Yes.
So
yeah.
How do you walk through that when somebody reads that and get them to thinking about this?
So we use a simple example to really help people attach themselves to this idea of if I'm talking to somebody and I said, if I own a bank and you own a bank, where are you going to deposit your money? Are you going to deposit in my bank or are you going to deposit in your bank? Well, that's an easy answer. Well, if it's my bank, it's my business, then I'm going to put my money in my bank or my business. And so that's an easy way to think about it conceptually. And then the process of actually doing it is just understanding what type of strategy is going to get me the things that I want, but get me the things that I say that I want. And that's where we get to come alongside somebody and help them understand what it means to capture their insurability, and really maximize the efficiency of their dollars through capturing benefits and guarantees at a minimum.
All right. So, Brock, let's think through it at a high level for those. I'm beginning to really understand that if we can explain it where a kindergartner could understand it, anybody can do it. All right. So if we think about banking, a lot of times I find out people are scared of that word. What do you mean to have my own bank? I don't want to be a banker. So let's define the characters in this play currently. We have you and I that we're talking about us having possibly a whole life policy on us. We have a mutual company that we're paying premiums to get that whole life policy current that has death benefit. So a lot of times it's hard to bridge the gap to with how does that mean becoming your own banker and income equaling premium. So at a high level, simplify that for us, how you would if you're visiting with one of your business owners that's in their 20s.
Right.
And, thinking through it.
Right. So if you look at a bank, you have the actual bank, right, where the money is held. And if you're the president, you are going to offer a depositor interest on their money if they bring it to you. So you have the bank and the depositor. The bank will pay the depositor interest if they keep their money at their bank. Now, the bank, to make money on that depositor, will then lend it out to someone else who will pay them interest. So there's three parties essentially within this whole banking relationship: the bank, the depositor, and the borrower. Where the bank makes the money is paying the depositor interest to hold their money and then lending that money out at a higher interest rate than what they're paying to control it. So their spread between interests would be going from 4% to 8%, right? So they would pay $4,000 to control 100 and then use that 100 to create 8,000, right? So of their own money, they created $4,000 of additional capital. Mm-hmm. In the world of us, our whole life policy at the mutual insurance company is the bank in this scenario. We, as the consumer, the payor, we are the depositor. And our investments or our assets that we put our money into by borrowing against our policy is the borrower.
And I'm going to add one piece on the characters of the play. If you become your own banker, there's also a shareholder. at both places. So Brock, are we the shareholder that benefits when we are using a mutual insurance company?
We are.
But what about when we make deposits at a traditional bank? Are we the shareholder that benefits from the growth of that bank?
We are not.
We are not. And so,
Unless you bought some stock.
yeah, or you were one of the founders of it, that's possible. And Nelson makes that point earlier in the book about what it would really take for us to start our own traditional bank. A whole lot of capital for a long time before we're able to utilize that. And so,
but there's a big difference. There's a big difference between depositing money and getting benefits and guarantees and being the shareholder versus just owning stock in a company, because obviously there's a massive amount of risk that comes with just owning stock by itself. And with depositing money into our banking system with a strong, dividend paying mutual insurance company, is we have those benefits and guarantees that come along with it. We don't even have to think about, is my money going to be more today than it was yesterday?
It reminds me of something I heard a guy named Tim Urich, who knew Nelson really well and spent a lot of time with him, said recently at an event we were at together. He said the key thing here when we're visiting with somebody that's new to this idea and concept is first to remind them that it does not require whole life insurance from a mutual company to practice infinite banking.
That's right.
People are trying to do it all the time through savings accounts, checkings accounts, qualified plans, crypto, equity in a house, farm equipment with equity, land equity, whatever the case may be. The real kicker is that it just so happens that whole life insurance with a mutual company that's dividend paying for 100 plus years is the most effective place to do this to and through. That's the key piece. And that really set me free in my thinking is like, hey, you're probably already doing IBC. You're just doing it through an environment that's not made and benefiting you the same way the bank benefits when you make deposits at their traditional bank. So if we understand that, I often say we're taking the product of whole life insurance with a mutual company and the process of infinite banking, and we're putting them together to make a cohesive movement with more power and more efficiency. So, Brock, there's a statement that.
Go ahead. It just reminded me, there was a question or a statement that came up in a conversation that Brock and I were a part of this week, where the guy said, I know this is kind of like an alternative 401k. And the reason why he said that, and my response was, well, it's actually way, way more than that. The only reason why he said that is because we're always trying to compare it to something that we know. And the reality is this process and owning a non-correlated asset that you have the ability to borrow against and control the environment, that is unheard of. There's nothing that we can compare that to. So anytime somebody is learning and leaning in, there's always this temptation to try to compare it to something else out there. And it's important to just understand that you're always going to fall short if you're trying to make a comparison to something else.
I think that brings up, that kind of segues into what Nelson really tries to get us to understand, Brock. He makes a statement here. I'm going to read it from the book. He says, it seems a little ridiculous, but my all-American man on page 17, so that's earlier in the book, is depositing all of his paycheck in a bank. And then he's writing checks, which I don't know if he writes checks hardly anymore, but he's making payments with checks of some sort for 34.5% of every dollar to pay interest alone back to someone else's banking system. So Brock, I know when you're teaching somebody Currents, which is just a cash flow daily operating system we teach our clients how to use, they don't realize how much drag is on their dollar before they ever get to use it. So touch on that 34.5% and what Nelson's saying, and bring it to life for somebody making 100 grand or 200 grand a year, and what they're really keeping and what that means.
Yeah, a lot of that has to do with the fact that our world loves consumer debt. And if you looked at their life, and it's kind of weird to see this, but if you look at someone's financial life and their income and paychecks, what you'll find is around 34% of their paycheck is going to mortgage, credit cards, consumer debt type things. And now you're like, if you took your gross paycheck, then you would subtract your taxes from it. And then the next thing, you'd subtract your debts from it. And then you have what's left over for regular spending and investing. And what you find is like, it's very common. I mean, very common to see that 34% of someone's gross paycheck is being sent to someone else's institution for borrowing.
Hey, Brock, is that systematically almost always?
It's
someone else's system.
Yeah, almost always.
Touch on that for a minute.
Yeah, so I think that what you'll typically find is until you get to the higher echelons of wealth, most people are borrowing from credit cards. They're using personal loans. They're taking intra-family loans from different people in the family. They're taking business lines of credit. They're taking, their mortgage with the bank. They're using loans from their 401k. They're using all of these different tools, and majority of the time, these loans are with other banks instead of something within their system, whether it's their own home equity line of credit, their own whole life policy, their own brokerage account. It's all almost always with some other bank institution that when they give up the payment to that other bank, it's completely gone.
So, Nate, when you hear that 34%, let's reverse engineer it. And let's kind of do a little bit of a role play. So you and I meet and you're interested in what Nelson's talking about on this page. And you say, hey, Brandon, I make $100,000 a year just because I need it to be simple math. And you tell me that. And then I ask you, but do you really? Do you really make $100,000 a year? What does that mean to you? Because this is what we're describing, right? We're describing this reality that what I make on paper and what I actually keep are two very, very, very different numbers.
Yep.
And so walk through how that conversation goes a lot of times, Nate, in regard to making and keeping.
Yeah. Well, oftentimes, currents is definitely part of that conversation. I was just having a call yesterday where we were talking about the three movements of money. You got your inflows, you got your outflows, and the difference between your inflows and your outflows are going to be your capital flows. That's going to be your free cash flow. So yeah, it doesn't matter how much you make, it matters how much you keep. Because free cash flow, capital flows, whatever, that is our ability to create something.
Whoa. Nate. You can't say it like that. Capital flows and free cash flow are not the same thing. We need to make sure we're clear with people about that.
Okay.
Yep.
Yeah, I see what you're saying.
All wealth is created through free cash flow,
Yeah,
right?
Yeah.
So as we earn our income, what we keep would be our net cash flow, our free cash flow.
Right.
Our capital flows is the action, the movement of taking that money that's left over and putting it to work. Cash flow engines in our life.
Yep.
So an example of that would be, as we talked about earlier, Rock gave the example of paying a $5,000 a year policy. And this is a piece I wanted to circle back to, Brock. Each year that you take that free cash flow and you put it in a capital, you put it in the capital flow or that cash flow engine, is that $5,000 becoming more and more efficient for you?
Absolutely.
Reuse. So you've taken $5,000 you were already saving, and you change the environment and gain multiple uses or benefits of those dollars guaranteed.
That's right.
Is there anywhere else you can do that with the same rules that apply to whole life insurance compared to other products?
The same rules?
Yeah. Same
Mm,
rules, same contractual benefits, the same
the
terms.
same
of that.
contractual benefits? No.
No. So if we simplify it, this is really about where Nelson said, where our wealth has to reside somewhere.
That's right.
So y'all challenge me on this. This is a thought I keep having. Wealth, first we have to get clear on what wealth means, but in the purest sense of money, which is what a lot of people associate with wealth, wealth can only be wealth in my mind if it's money we're keeping or passing along inside an ecosystem that we control in the money sense. Would y'all agree with that? Would you push back on that? How would you think through that?
Well, if you're not keeping anything, how can you even call that wealth?
Okay. On the money sense, I agree. That's where I'm kind of going with this, because how many times have we met with somebody and they've got 150 grand in the bank, traditional bank, and they say, look how wealthy I am, but they have money leaking out everywhere else inefficiently. You know, maybe it's through inflation or interest or the 34.5%. And they don't even realize that a repositioning of where their savings goes or that free cash flow could create so many more benefits just by changing the location. And that's what Nelson was trying to get us to understand, is that this is happening. Brock just described to everybody. Almost always when we look at someone's numbers, because we don't want to guess, we bring everything to the table, 34% is going to someone else.
Yeah, I think what you're really saying is wealth sometimes can be an illusion if you don't really know what's going on.
That's good, Nate. That's good.
That's
Let's
like,
touch on that.
yeah,
Go
let's
ahead,
touch on that. That's something that Nate and I actually went through. And Nate learned last year, maybe, or 2 years ago, where, and Nate, I don't, this is not me calling you out or anything. This is just a
You're
good
good.
example because we've used it before. But Nate had this very knowledgeable sense of, here are the supplements that I take, here are the vitamins I take, look how healthy I look on the outside. But then Nate and I were introduced to a doctor where they do our blood work and they run all these panels. And then he got a sense for what it actually looks like under the hood of what's going on and found out things that he was not aware of. And so now it becomes a choice to him on whether he acts on that. Well, it's the same thing in our life currently with financials. It's like, well, on sheets of paper, it might look really good that on your balance sheet that today everything looks fine. But if you look at the income statement and you look at your whole financial life impact together, what you might actually find is that some things below, there's a lot of things leaking in your world. And now you have a choice of, do I improve it and make it better, or do I continue on as is?
So that reminds me, I have a friend. I haven't talked to him in a while, but we used to do a lot of ministry work together. And he did some youth evangelism type stuff. His name was Cody. He wouldn't care if I shared this because he shared it many, many times from the stage. It's just part of his testimony. Um, a long time ago, he got into bodybuilding big time, and he had this certain image that he had to maintain in his mind. But in order to maintain that image, uh, and try to keep his body fat or whatever, he developed an eating disorder. And so when you looked at him, you're like, this dude could be on the cover of Men's Health magazine. Like, he was just like ripped, all this other stuff. But when he went to the doctor, they discovered that because of the damage that had been done from his eating disorder, his organs were like 80 years old. Like they were the equivalent of an 80-year-old. So they had to work to fix all that stuff. And so on the outside, he looked like he had it all together until, like Brock said, until they went under the hood and they discovered what was really going on.
I really like that analogy. Let's stick with the under the hood. So the only way that a car gets worked on or gets maintenance done is if the driver or the owner of that car decides to take it somewhere to get it looked at,
That's right.
which requires.
Mechanics don't go door to door knocking. Hey,
That's right.
can I fix your car?
That's right. Which is pretty cool because Nelson talks about the vehicle example with how we treat our banking system through whole life. And he makes the point that the same system could be given to Brock and Nate, or they could start the same system, but how they treat it, drive it, and maintenance it by the behavior of themselves leads to the longevity and the benefits and the mileage and how well it runs. And that's a really hard piece to understand early on, but it reminds me of what our mentor says all the time, James Nethery. He says these two things. He says premiums are the solution. And the older I get and the longer I do this, it's becoming more and more clear what he means by that. Because is it guaranteed that we can pay premium tomorrow for a whole life contract on our life?
Not if you don't have it.
Not if you don't have it. And so I had this conversation recently with somebody who's been going through a process for a while, and he messaged me. We have a very good relationship, so I want people to know that I don't get this blunt with people I don't know well. And he messages me and he says, hey, I got a lot of things on my plate. I really believe in what this is. I've already read Become Your Own Banker. It makes a ton of sense. But I need to focus on these other things. I'll holler back at you in the new year. And so I responded back and I said, hey, I'm going to send you an audio text because I like people to hear my voice when I'm asking tough questions, not just read it on text. And I said, hey, I love your thinking and that makes sense, except for you haven't done as compared to what? Are you okay if I walk you through a scenario as compared to what? And he said, sure, I value your opinion. So I said, you're assuming that you will remain healthy for the next 3 months. You're assuming that you will create more value in the things you're working on now to protect your family than having death benefit protection for if the worst case scenario happens, i.e. you leave this earth unexpected. And he goes, man, that's a great point. I've never thought about that. So I said, the real question is are you willing to prioritize this now to create peace of mind of knowing worst case is covered and grow into that with your thinking, or do you want to delay that? He's like, I'm going to have to get back to you on that. My point to that is when we go see a mechanic, I don't want to work with any mechanic. I want to work with a mechanic who's going to tell me the truth, who's not going to charge me something to get something fixed that doesn't need to be fixed, who's going to go, hey, do you really need this thing because you only do highway miles or you only drive country miles or, this kind of, and they are educated in how my vehicle runs most efficiently. So I have a mechanic now locally that 2 times I've taken my vehicle in and it has had problems, I thought, because I am not trained as a mechanic and this didn't seem right. And they kept it for 2-3 days. They drove it, they checked it out, they put it on their software, all the things. And they called me back both times and they said, we don't see anything concerning enough to charge you to get something fixed. Just bring it back to us if it happens again. Do y'all think I'm going to go to that mechanic for the rest of my life?
Absolutely.
That's what we value and how we operate with people when they bring their vehicle in. We're just helping you see if it's running the way you want it to. And where do you want to go? Are you on a cross-country trip? Are you trying to just go right down the road?
Yeah.
And do you have the vehicle maintenance in a way to allow you to do that?
It's funny because I have a similar story from 2008 when we moved to Beaumont, Texas for the first time. I had a vehicle that had an issue with it and I didn't know where to take it because I was new to the area. So I asked a friend of mine and he told me where he would recommend. So I took it there and they fixed it and I got in a quote somewhere else and they fixed it for less than what the other person was going to charge me. But whenever I went to pick up my vehicle, he said, hey, anytime you're over 100,000 miles on a vehicle, he said, if you'll get you some of that Behrman B12 chem tool and put in there, he said, you'll have a lot less issues with your vehicle, which means you'll have to bring it to me a lot less. And I was just like, Okay. And so started doing that. Then we moved out of the area. But as soon as we moved back into the area, guess who I started going back to?
Mm,
Immediately.
I love that. So let's tie all that together with where we started, Brock. Expanding the system to accommodate all income. So if somebody is new to the idea of becoming your own banker, the infinite banking concept, and dividend paying whole life insurance with a mutual company, that's a lot of words. And they're trying to take over the process of banking in their life. Does the number of policies matter as much as the capital we control through the policy?
No.
No. So a lot of times I get asked, Brandon, why do you say you would have started with more premium earlier if you knew what you knew now? Then it's because in the vehicle world, a vehicle can only go so far before it becomes less efficient. Paying premium is the opposite. It's like the vehicle gets stronger, gets more efficient. It can go longer miles with less tune-ups. It does all these things because it is built that way by design. So Brock, walk through real quickly. First and foremost, Nelson's number one principle was think long range. And on page 85, he makes a statement about this would take the average person 15 to 20 years. So that's the first piece. And we were talking before we hit record about how wild it is that 20 years goes by like that. So we have to embrace what it really means to think long range. And that's going to be uncomfortable because we live in such a consumer based, give me, let me have it as fast as possible world that we're all guilty of falling to. So Brock, what does it mean if we were starting today when we started our first policies and we're looking 20 years into the future? What does it mean as far as income expanding and our incomes getting into premiums? What could that look like? Like give 2 or 3 different examples so people understand it's not the number of policies. It's a place to put wealth.
Right. Yeah. So when you look at someone at the ages of, call it 20 to 25, they're just starting their working career. The likelihood is they're at their lowest economic point of their life, hopefully. Right. And as they continue to get older, they'll have promotions, they'll have raises, they'll get bigger paydays. And so what you'll find is if you do things correctly, you'll have more money to save each and every year. Well, when you start out, oftentimes people don't want to put 100% of their free cash flow in a policy, which is fine. However, you have to take into account if you think long range, you're going to be able to put more capital into a policy later on in life because of the fact that you have higher incomes. And the longer that you put premiums into the whole life policy, the better and more efficient those become. And so, what you want to be able to do is when you start out with a healthy base premium with some PUAs that allow you to start the policy, right? Have that early cash value that some people talk about. And then as you continue on in life, those cash values will grow continually and those premiums staying the same will just become more and more efficient. And then once you come to a place where you find out, oh, wait a second, I have a lot more free cash flow left over even after paying my premiums each and every year. All right, well, now it's time to start your next policy. It's time to start the next premium with that new free cash flow that you are starting to notice over and over again.
Yeah, I've never looked up the actual numbers on this, but Nelson uses the example in the book about an airplane and how as it burns off fuel, it becomes more efficient. So I looked it up. A Boeing 737, the empty weight of the plane itself is around 91,000 pounds. The full capacity of the fuel tank is about 46,000 pounds.
Wow.
So as the fuel burns off, the plane gets lighter, which means it's not having to work as hard to maintain the same speed. I mean, that is a perfect analogy to what happens with your policy, that in terms of just thinking about the efficiency of it and why it gets better the longer you have it.
What you guys have just said, I think it's a great way to to kind of tie this all up with a bow, our money's going to flow for our entire life. We will receive money from somewhere. We will deposit it somewhere. We will try to use it efficiently somewhere. The real question is does the location, the environment, the place it goes to get stronger and stronger and stronger for us and give us more access and control and functionality, or does it give someone else more access, control, benefits, and functionality? That's really how simple this is. The hard part is changing your thinking, which is one of Nelson's principles, which is we have to be willing to rethink our thinking. So I was visiting with one of our newest members yesterday. She's 62, and bravo to her. She almost said, I can't do it. Now, she has plenty of capital in plenty of places, but you know what led her to starting? She kept leaning into rethinking her thinking. I could just encourage her to do that. I could just say, hey, you got your car parked in the shop. You got to decide if you want to change the oil. You got to decide if you want to take this motor out and put a new one in. You got to decide all those things. But she made the conscious choice to rewatch a lot of our conversations, listen to the podcast, reread Becoming Your Own Banker. And so I thought we were getting on a call to have a discussion about maybe just not starting now based off of our previous conversations. And she said, hey, Brandon, I've spent 4 or 5 hours rethinking my thinking, and I'm ready. It makes enough sense for me to start. And that right there alone is a great description of we want people to think about how they think. We don't want to work with people that we tell how to think. We all get better in the world if we're thinking about how we think. I think Nelson said it this way, he said, 85% of people think they think, 10% of people actually, what does he say? 10% of people think about how they think and 5% actually think, or something along those lines. Basically, it's like most of them are just walking around with a system in place to not think. Yeah. You know, said another way, there's what we know we don't know, and what we don't know we don't know. And we want to be around people that push us and challenge us to go through those steps over and over and over again. So my challenge to anybody listening, watching, is where are you getting uncomfortable enough to challenge your current thinking in any area of life? It doesn't matter what it is. Nelson talked a ton about arriving and the arrival syndrome. And it's one of the most dangerous things that if we're not aware of it, it will eat us alive from the inside out.
Here it is. The quote from Thomas Edison, actually, it was Nelson quoting Thomas Edison. He said, 5% of people think, 10% of the people think they think, and the other 85% would rather die than think.
That's it. Thanks, Nate. That's so much better. Thank you. All right. So which percentage of those are you? Which one do you fall in? But here's the coolest thing. You can decide to change. But as I told somebody yesterday, you can't hang around people who want you to change more than you want to change. It has to be where you want to make that change. So, guys, thanks for your insight today. Expanding our system to equal all income is a long-range thought process that requires rethinking our thinking. At a simple level, if you don't want 34% of all your money going to someone else, then reading Become Your Own Banker and diving into how you could start shifting that in your direction. What's the worst thing that could happen? You learn something new and you go, oh, this could be a blessing to our family, to our business, to our value that we bring to the world. So guys, appreciate y'all, and we'll catch everybody the next time. Thanks for listening. Hit those likes, subscribes, all those things, leave comments. We're very grateful for all that, and that you share your most valuable asset, your time with us. Have a great day.